Hi, I'm Ron Ianieri of Ion Options, and I'd like to welcome you to Introduction to Options. Well, whenever you begin anything, it's always best to start at the beginning. And in starting at the beginning, especially when you're learning options, you have to realize that there's a lingo that you're going to have to learn. Not only are you going to have to learn new concepts, not only are you going to have to learn new thought processes, but you're going to have to start with just understanding a new lingo. Options has a language of its own. And without understanding that language, it's going to be very, very difficult to learn options. So let's start off with first, what is an option? An option is an exchange-traded derivative product. Now, what does that mean? First off, when we say it's exchange tradable, it means that this option is actually traded on a regulated exchange. An exchange that is regulated not only by the exchange itself and its market watch department, but it's also regulated by the SEC. So we've got an exchange tradable product. And it's a derivative product, and that's something that normally scares people. They hear that word derivative, and the first thing they think of is trouble, risk. Well, guess what? When you think about just the word derivative in and of itself, derivative is not a bad word. It doesn't mean trouble. It doesn't mean danger. It doesn't mean risk. When you think about it, ice cream. Yeah, I said ice cream. Ice cream is a derivative product. It is derived from milk. Further, when we talk about the pricing of ice cream, we know that ice cream gets its price from what? From the price of milk. So when you go to the ice cream store and you're over there and you're ordering your hot fudge sundae with mint chocolate chip ice cream, you notice there's a sign there. It says, due to the rise in the prices of milk, all of our ice cream is 20% higher. Why? Because ice cream is a derivative of milk. That's all derivative means. If ice cream's not a bad thing, and I don't think you think ice cream's a bad thing, then derivatives aren't really a bad thing. So an option derives its price from the price of another underlying product. Now, that underlying product could be anything. But what you have to understand is all the term derivative means is that the price of the option is derived from the price of an underlying security. We need to know that an option is a contract. It's a contract between a buyer and a seller. And we need to know that each contract, when we're talking about stock options, each contract is worth 100 shares. Now, obviously, there's more than just options on stocks. There's options on currencies. There's options on indexes and ETFs, commodities, bonds, futures. Almost every product has options listed on them. Now, I'm not saying that you just need to know how to trade the option and don't even worry about the underlying product. I'm not saying that. You need to know the underlying product that you're trading. Definitely. But once you understand that underlying product and you become reasonably successful at trading that underlying product, it doesn't matter what that underlying product is. The use of options will make you better at trading it. It'll make you more profitable and it'll make you less risky. So that means we're going to have more profits with less risk when we use options properly, no matter what underlying product we trade. Now, there's basically two types of options. There's a call option. The call option gives the buyer the right, but not the obligation, to purchase a specified security at a specific price by a certain time. So that call option, remember, gives you the right to buy, but not the obligation. And that's very important. The second type of option is a put option. And a put option gives the buyer the right, but not the obligation, to sell a specific security at a specified price by a certain time. Again, the option buyer here, whether they're buying a put or a call, doesn't matter. The buyer's got what? The right, but not the obligation. That means the buyer is in control. So we've got a call, which gives us the right to buy, a put, which gives us a right to sell. We have two types of values of options that you're going to want to look at and get real familiar with. First type of value is called intrinsic value, the amount by which the option is in the money. Now, intrinsic value reflects an option's value relative to the stock price. So, for instance, if I'm looking at a call and I'm looking at the 30 strike call, I am going to have the right to buy the stock at 30 at some point in time in the future. Now, if some point in time in the future comes along and the stock is trading at 40 and I have the right to buy it at 30, I can exercise my right to buy it at 30 and then go out into the open market and sell it for 40. That's going to give me an instant value of that option. That option in that case will be worth at least $10. Why? Because I have the right to buy it at 30, and then I can go out and sell it in the current market at 40. That's a $10 value. That is intrinsic value. I've once heard intrinsic value called satisfaction value. You get immediate satisfaction. You get to buy the stock at 30 through your 30 strike call, and then you can then go out into the open market and sell it at a higher price, thus making you money immediately. Immediate satisfaction. That's what intrinsic value is. The fact that the option already has an innate value to it. Now, there's a value beyond that. There's more than just intrinsic value. There's something called extrinsic value. And the extrinsic value is defined as the amount of an option's price that is over and above intrinsic value. And this extrinsic value reflects an option's value in relation to time and volatility. So, for instance, if I look at that 30 strike call and I know that the stock is currently trading at 40 and I exercise my right to buy the stock at 30, and I can go out into the open market and then sell that stock at 40, I know there's a $10 value there. Now, if the option was trading for $10 exactly, then the option would be trading with only intrinsic value. And when an option trades with only intrinsic value, we say that that option is trading at parity. And that's short for at parity to the stock price. However, if that option was trading for more than $10, say $12, well, obviously, only $10 of that option's $12 is intrinsic value. The option is not trading at parity, because if it was trading at parity, it would be only trading for the $10. But if the option is trading for $12, then there's $2 of option value that is over and above the intrinsic value. That is the extrinsic value. So we have that option trading at $12. We know the intrinsic value of that option is $10. The 30 strike call with the stock trading at